All right, hi everybody, and thanks for listening to this video presentation. So what I plan to do in this video is just provide a quick earnings preview on Apple. They're set to report after the close on Thursday, October 27th. We have a more in-depth thematic that we actually published on Apple's earnings outlook, and that can be found on marketscopeadvisor.com, and you're more than happy to check that out. The video clip really only intended here to provide some of our high-level insights. So here's our standard disclaimer. Just take a quick read before we move forward. So Apple is set to report their September quarter results again after the close on October 27th. It's also their year-end results. So we did cut our 12-month target price by $10 to $165 back on October 18th ahead of the results. And we keep our buy recommendation. And really, the price here, our target price is based on a PE of about 23 times our calendar year 2024 EPS. That is above hardware peers in the broader market, but we see it as warranted given their free cash flow potential and their balance sheet. So for the quarter, we expect a September quarter beat, but a more cautious tone for the December quarter from the management team, really given the uncertain consumer spend environment out there. The biggest positive the company really has going for itself right now is that consumers really appear to be willing to pay up for those higher priced iPhone devices. And that's part of our long-term secular thesis, and I'll discuss this more in depth in a minute. Headwinds here are some of the stuff that other companies really have to contend with, and that's really the macro factors out there, rising energy costs, and unfavorable foreign exchange environment. We actually expect this quarter, the September quarter, to be about a 500 to 600 basis point hit towards Apple's results, and it's actually going to be more pronounced in the December quarter. And because of these factors, we actually see revenue and EPS risks as the iPhone cycle starts getting longer in the tooth, and this could lead to potentially some temporary stock underperformance, as it has really been a standout outperformer here over the last year. So the next slide here, all eyes really will be on the iPhone this earnings season. It's more than half of their revenue base. We actually forecast revenue growth of about 10% for the September quarter, and a more modest 2% increase for the December quarter. Now, the early launch of the new iPhone devices was actually a week earlier than many people anticipated, and coupled with the easing of supply constraints throughout the quarter, we think will help allow for Apple's September growth to look more attractive than it would otherwise have been. While we expect both higher average selling prices and volume in the September quarter, volume probably dries out in the coming quarters on consumer softness. But that said, the higher average selling price environment should be sustained throughout the iPhone 14 cycle versus the 13 cycle. And the main reason being is that the Pro versions have really set themselves further apart from the standard iPhone versions. So the two higher end Pro versions. And we believe this was an intentional move by Apple to help push consumers more towards these higher price models without actually increasing prices. It also helps contain costs by limiting enhancements on the lower price phones. Also, Apple removed kind of the iPhone mini from its lineup in favor of the larger Plus screen, which naturally, again, supports higher prices. Compared to the standard iPhone, the two standard iPhone models, the iPhone 14 Pro and the Pro Max features, much more enticing enhancements like a 48 megapixel camera, faster, more efficient A16 chip, 4 nanometer technology. So there's a lot of reason for investors to kind of pay up incrementally for those higher Pro devices. And I'd say my final comment on iPhones is I think investors should really be mindful of the cycle risk here as you kind of go into the March quarter and the June quarter. You do have tough comps. The China-Europe weakness is going to be there. However, kind of if we do see this treacherous iPhone cycle as it kind of extends, we would be more supportive for investors to use it as an enhanced buying opportunity, given our longer-term thesis on the stock. So next slide here. As far as Macs and iPads are concerned, we're kind of entering tougher times given what we're seeing from the broader end demand landscape, combined These two businesses represent just under 20% of Apple's revenue. On the Mac side, September quarter revenue benefits from some new product launches. They officially announced their new M2 chip back in June at its developers conference, and we've seen some Mac upgrades on that side of things. Macs are also taking significant share in a sharply declining PC market, but it's really hard to tell and get a good feel on true demand. Some of these independent providers, the IDCs, Gartners, Canalys of the world, have all very different outlooks on what the Q3 Mac demand outlook look like. But we forecast roughly flat sales here in the September and December quarter at a time where you're looking at about near 15-20% declines within the PC market. And clearly comps are going to get more difficult here over the next couple of quarters. But that being said, the thesis for Macs remains intact. Now, Apple rolled out some new iPad Pros and an entry-level device here in recent days that's going to start selling in late October, and we think will help boost the December quarter numbers. Also, a year ago, iPad sales suffered from severe supply constraints. So on the iPad side of things, you're actually going to get some very easy comps for the December quarter. Now, overall, for both iPads and Macs, holding up, I think, most importantly, better than their respective end markets. And a lot of that really does have to do with the release of the M1, M2 chips in recent years. They've proven to really offer considerable internal upgrades. And at the same time, they're making Intel look very inferior in a lot of the kind of other PC vendors out there, much more inferior to the Macs. Also a cost saver for them and helping them to really boost margins because they're internally manufacturing these chips. So, as we kind of now move towards services, on the next slide, services only 20% of Apple's revenue base, but generates closer to 35% of its profits based on our estimates. It's the most important growth driver for the company and to the company's valuation. Now, this is no longer kind of growing at the 20% plus pace that we saw during the pandemic, but we think 8% to 11% revenue growth through mid-2023 is sustainable in the face of very tough comps and Forex issues. Constant currency services is actually growing closer mid-teens, mid to high teens percentage, so 15 to 17% growth. Now, on the licensing side of things, that's about a quarter of the services revenue for Apple. Provides extremely good visibility during uncertain times like this. Really an anchor for the company and limits their downside EPS potential should we really see a big decline in some of their core hardware businesses like iPhones. You kind of look at some of their other services, the App Store, Apple Care, iCloud, they remain very healthy kind of contributors towards services. And then on the subscription growth side of things, it's something that could be better monetized. They've more than tripled their subscriber base here over the last 4 years, and opportunities in areas like bundling and gaming really has the potential to really significantly drive higher revenue from the user base over time. And we think it will kind of evolve over time. But essentially, Apple is really looking to kind of take a greater percentage of consumer dollars. And again, we expect them to continue to be successful like they have been over the last 2 decades on the hardware side of things, but going forward more so on the services side of things. So next slide here, and this will kind of be my last slide. Just quick take on our investment thesis, which we really kind of gravitate to on a longer term basis. But at the heart of it is kind of the first bullet here. Company is an absolutely great compounder. Massive free cash flow generating north of $100 billion in free cash flow, which is allowing them to buy back anywhere from like 3 to 4% of their shares on an annualized basis, which we think will help kind of that long-term EPS growth trajectory of at least 10% plus. And they'll be able to do it based on the below factors I listed out here. Growth in the installed base, probably the most important stat when looking at Apple. Last 2 years, the highest ever switcher rates we've seen for Apple, so switcher rates from Android to the iOS ecosystem. And we see this being uninterrupted, even if the iPhone cycle, a 14 cycle disappoints. In fact, would love to see the iPhone cycle disappoint in some respect. Investors more of an enhanced buying opportunity to buy the stock. Now, we assume no growth in core hardware business, in their core hardware business, that being iPhones, iPads, and Macs, while average selling prices we assume at 0 to 3% long term, basically growing at the rate of inflation. We think the good visibility on higher average selling prices in the future cycles is extremely important towards our thesis on Apple. So, for instance, next year the new iPhone 15 phone should have a higher price Ultra device in there. In 2024, we expect Apple to start rolling out foldable phones, which will further have higher selling prices. So there is kind of a trajectory out there for Apple's kind of thesis to continue for consumers to pay more up for Apple's devices. Now, overall, the pipeline we also think remains extremely attractive on both the hardware and the services side of things. In the hardware side of things, they're talking mixed reality headsets next year, potentially AR glasses over the next 2 to 3 years, Apple Car, longer-term vision, healthcare, fitness-centric devices, even if it's just on the watch side of things, but having kind of become more of a health device, I think kind of will continue to increase the adoption of those devices and help the stickiness in that ecosystem. And then on the services side of things, advertising, gaming, and bundling are the 3 opportunities we've listed out there longer term that we think the street is underappreciating. So, just to conclude, I'd say we are definitely in a softening macro environment, but we feel very strongly that Apple's business prospects in their brand are stronger than ever and would be buying shares in times of market distress. So, there you have it. I kind of just want to thank everyone for listening, watching this presentation, and definitely visit our website at advisormarketscope.com for more information on the thematic tied to this presentation, or for that matter, just to get details on any of our research, for the companies within our broader coverage universe. And that's all I have. Thank you.